Have you ever tried to time a market entry only to watch the trend completely reverse the exact second you jump in? It feels like trying to catch a massive wave, only to have the water instantly pull back and leave you stranded. Professional traders avoid this trap by ignoring gut feelings altogether. Instead, they rely on objective momentum indicators, most commonly the standard MACD, to confirm a trend before putting any capital at risk. Relying on the standard MACD in Forex creates a mathematical problem. Here, USD JPY trades in the hundreds, while EUR USD trades in tiny decimals. Because they operate on completely different scales, comparing the absolute strength of their movements on the same chart physically breaks the visualization. Forcing absolute numbers onto Forex pairs makes it difficult to judge if a move is genuinely strong or simply a byproduct of a high price. Without relative context, you're left guessing at the true strength of a trend. To cut through this distortion, you need a tool built specifically for relative scale, the Percentage Price Oscillator, or PPO. Under the hood, the PPO uses the exact same base data as the MACD. It tracks a short-term 12-period exponential moving average and a long-term 26-period exponential moving average. Instead of measuring the absolute difference between two intersecting averages, the PPO extracts the gap and converts it into a percentage. This percentage-based output levels the playing field, mapping radically different currency values side by side on a single unified scale. By converting raw price into relative percentages, the PPO translates completely unmatched market data into a standardized, objective metric of trend strength. Start with the center line crossover. The thick PPO line oscillates around a distinct zero mark, serving as your primary trend filter. When it moves above zero, the short-term average is higher, showing bullish control. When it drops below zero, the bears have taken over. Once you have filtered the overall trend, precision timing requires a second layer, the signal line crossover. This close-up highlights the main PPO line intertwining with a thinner 9-day signal line. When the PPO line crosses above the signal line, it triggers a buying opportunity. A cross below warns that a sell-off is imminent. Beyond simple crossovers, the PPO can also serve as an early warning system through divergence. Look at this dual chart layout. On the top graph, the raw currency price is making a new higher peak, but down on the PPO oscillator below, the momentum line fails to reach a matching high. These signals work together in sequence. They ensure you stay aligned with the broader trend, trigger your entry at the optimal moment, and warn you to exit before the momentum collapses. But we need a reality check. The PPO is an analytical lens, and it has limits. For reliable entries, you must cross-reference its readings with established support and resistance levels on your price chart. Watch out for visual danger zones. In a choppy market, the PPO line flattens around the zero axis, generating messy, overlapping signals. This flat line indicates zero market conviction. Trading these false starts causes portfolio-draining whipsaws, so avoid these setups entirely. And you must always protect your capital with strict stop losses. Even a clear PPO signal can be instantly overturned by an unexpected central bank announcement or sudden economic data release. When applied correctly, mastering the PPO shifts your focus away from the distracting noise of absolute price movements. It trains your eye on the pure signal of relative momentum, giving you a distinct edge in a notoriously unpredictable market. Try it out today. Open your trading platform, apply the PPO indicator to your currency pair, and wait for that next zero-line crossover. And if you found this breakdown helpful, subscribe for more daily market insights and technical deep dives.